Good morning, ladies and gentlemen. Well, by hand, my calculations are that we are at minus 28. But unfortunately, it is absolutely meaningless because in this rapidly changing environment with the war that's going on and the sanctions that keep on being piled onto Russia, the macro narrative is changing by the day. So, unfortunately, these scores are not going to be able to keep up or help in the next few days. I seriously considered whether doing a video today would be helpful at all. But then I finally decided that yes, I would lay out my visions of how the macro is changing and how it will change according to certain events play out. Unfortunately, bonds are not going to be, or the yield curve are not really going to be able to foretell anything. They're just going to react to events like everything else. But certain narratives will push bonds in certain directions, and that will have a huge effect on risk assets. So that having been said, and basically take everything with the pinch of salt that you must take it with at the moment, let's examine what the possible outcomes are and how the markets should react to them. The news over the weekend that basically the Russian central bank is being excluded from SWIFT means effectively that the ruble is being made non-convertible. Why? Simply because the Russians will not be able to use, the central bank will not be able to use its reserves to meet the obligations of the commercial banks. So how does an importer of goods from Europe pay for those goods, and how do they sell it to the Russian population and obtain the necessary euros that they expended back? So basically, an importer would have to pay in euros for the goods, and then he would sell them in rubles to the population, and finally he would have to transfer back these rubles into euros to pay for the imports. A, he can't get the letters of credit, and B, he can no longer go to the central bank, or his commercial bank can't go to the central bank and do the final transaction, which is take the rubles and convert them back into euros, so he is net square. That means that basically he just can't physically buy any imports. And we know what those imports are. Those imports are mainly cars and other technical machinery, etc. So basically it means that trade between Europe and, because that is where most of the trade takes place, between Europe and Russia is effectively banned. It's just stopping. Now that's going to have many effects on primarily the banks, because the banks now are screwed. Whatever exposure they have in Russia is effectively written down to zero, and whoever made their living by selling a large proportion of their production to Russia is also screwed, because that stops on a dime. How long that lasts, well, your guess is as good as mine, and it all depends on the war. How long it lasts and how long the sanctions last, etc., etc., etc. So it's absolutely impossible to say what the short-term effects are, and it's also impossible to say what the long-term effects are at the moment. What are my guesses? And these are guesses. They might be slightly better than a monkey with a pin, but I wouldn't say they're much better than a monkey with a pin. They're not much better than 50-50. In the short term, I would have thought the ECB will react by doing nothing and continuing with their asset purchases just to see what the carnage is. And therefore, I would expect the shorter maturities, like 2 years, to come back down in yield. And these levels are still very, very important. I would not be surprised for the 2-year note to go all the way down to minus 57. If we change to the 5-year note, I really would not be surprised after today's news about the SWIFT banning of the central bank if 5 years collapsed all the way down to minus 31. And and the Bund might go all the way back to minus 63. Those are no, not minus 63. This is minus 6. That kind of move from the bonds. It's just impossible to tell, because the first reaction of the markets should be one of panic, because simply the banks in Europe are going to be hit really, really hard. Now, there are various possibilities. They could just let their subsidiaries in Russia fail and just write them off. Who knows? I mean, every bank will decide for itself what's best for it and its shareholders, but the hits are going to be very, very large. I mean, will this be in some way made up by the huge new defense spending that's going to be taking place in Germany, an extra 100 billion that was announced? Yeah, maybe, but the first reaction is going to be a big risk off, with rates coming down and people basically just buying safety bonds. I just can't see how that can be avoided on Monday, Tuesday. We basically moved nowhere last week, but I think this week we're going to have a pronounced risk-off move, because the news of the SWIFT is going to affect the banking system a lot. I'm no longer a seller of futures at these levels. I am no longer looking for higher rates. I think we might come down quite a bit before that happens. I'm looking at, a move of France in the morning through the 61, I think would probably let the market collapse all the way down to 28, 29, to this kind of level. It's going to be very, very volatile on Monday, simply because these are unprecedented steps. Never before have 400 billion out of 600 billion of reserves been frozen. And that's a lot of money. So it's really going to be volatile on Monday, and I want you to understand why it's going to be very volatile on Monday. The ECB will have no alternative than to support the banks by continuing buying assets, maybe even at an increased rate. It all depends how bad the situation in internal balance sheets of the banks is, and that is at the moment unknowable. This is the differential between bunds and 10-year notes. On Monday, I would expect the pressure to be all on 182 and start going up towards 194. Simply because of the damage that is being done to the banking system in Europe. It really, it depends. If we start breaking 182, I would have thought that the reaction in Euro USD is going to be to collapse down to even below 110. So that is going to be what you need to watch, or what we need to watch first thing in the morning. If we start breaking this 180 to 182 area and start trading 184, you could get an accelerated, sell-off in bond yields, and therefore an acceleration of dollar strength. That is what we need to watch. And really, I feel stupid even commenting on because events are changing so rapidly that what was true 5 minutes ago is no longer true. But that is going to be what is going to be interesting in the morning. If we start breaking 184, you really have to start selling euros against everything. The response from the US yields should be less pronounced, but still they will definitely get knocked back. And really, you're looking in 5-year notes, you're looking for 161 and maybe 145 again. Those are the levels that you are looking for retracements to go again. It's definitely going to be less in the US, but still it's going to be in that direction. If I change it to tens, really you're looking for something like 169, something like that. And 30s, you are probably looking for this kind of level, 209. The yield curve should definitely steepen. It did absolutely nothing last week, and we can even have a look at that. As you can see, 530s did absolutely nothing. A small move back towards 56 is what I would hazard a guess happens. But basically, you are looking for more or less. This is not a period where people are going to be really trading the yield curve. You are looking for more or less parallel shifts with each individual tenure going at different times, as it were. But certainly there should be some panic, because the situation for the banks, or for the US banks, is nowhere near as bad as for the European banks. But I would have thought that a decrease in yields to these levels I've just talked about is more than probable. As I said, really you're looking for the euro to take the brunt. So what could easily happen on Monday is that we start going back up, and 98.54 is going to be absolutely key. You saw that chart of the differential between 10-year notes. If it starts breaking above 182 basis points in differential, I really see nothing that can stop the dollar going above 98.54 and even hit these areas around par. It's just basically what the flow of money is going to do. If we change this now to a weekly chart of the Euro USD, you will see 109.92, and that is basically where I would expect the euro to trade over the course of the next couple of weeks, if indeed the situation remains the same. But don't forget that you could very easily and very quickly have a big reversal and some kind of a peace treaty and everyone walking everything back, and then everything changes. So this is a period to be very swift and not hold, stay around with positioning. Right, gold, what to say? Well, this is the background. The Russians have got basically $200 odd billion of reserves in gold. And if if 600 billion of currency, dollars, euros, etc., has been frozen, or effectively they can't use it, then the only thing they can do is sell gold. And this is why you had this amazing candle last week of gold, and this is the reason why I kept on telling you that gold is probably not the thing that you should be buying, because the uncertainty of what is going to happen and what the Russians have to do with their gold is just too great. Do they need to sell gold? Can they do some kind of a repo facility with the Chinese? Yeah, who knows? This is all stuff that we absolutely have no idea about, and which could happen and could not happen. But the levels won't lie. If we start breaking through this 118.81 level, and you can see how we bounced off it a couple of days ago, you are going to go all the way down to 1830 and possibly then all the way down to 1764. This is big power politics games, and the Chinese could drive a very, very hard bargain with the Russians. We just don't know. And anybody who tells you that they know just is lying to you. Effectively, I can't see any alternative that the Russians have but to sell their gold. And that is why they might even stop selling gas to Europe, and that is going to have nuclear effects on the European economy. So basically, this is going to be pain for everyone, and all we can do is know what the levels are and basically trade at those levels with stops and just do options. My guess is that the Russians will do some kind of a deal with the Chinese, or that they've already done a deal with the Chinese, and therefore, if we drop down towards the 1830s, I will be a buyer of some calls. But that is all I can say at the moment, and and you can see why is all I can say. If we actually turn to a chart of DBC, you can see that we reached my 24.39 level and backed off hugely, and I got out here. And now we could just sort of meander about, but if something bad happens, we could have one of these reactions. Go straight through and boom, go up, the equivalent of 20%. So you can see how unstable the situation is. I never thought that the reason why we got up here to 24.39 would be a war. I thought it would be normal trading, and the market did react off it. But if we have a look at the chart between gold and commodities, it could quite easily be that next week you get some news of some repo facilities between the Russians and the Chinese at some ridiculous level, and this collapses straight down and commodities go straight back up. So it's very difficult to say, apart from don't be married to positions, and as the narrative changes, or if the narrative changes, I will change my view and post it on the Twitter and tell you that now I think that the reasons have changed. But if we look at CL, at oil, you can see that basically we did a doji last week and closed more or less unchanged. If the Russians stop all sales, through 97 we go and probably take out the highs at 110. Absolutely impossible to say. This is big, geopolitics, power plays, and we really have to see what happens in the end. One thing that I think is obvious by the end of this, either we have big deflation or big inflation, but we don't have to decide now which one it's going to be, i.e. we can just afford to react and then get on board once the situation clears and the fog of war disappears. We will be able to decide which it will be. Now this is SPY over DBC, and as you can see, it's touched the trend line, basically the channel that goes all the way back to 2008, and whereby equities have been gaining on commodities. What this chart basically says to me that if things quieten down, you will see a massive rally to about here, to these levels, 21. So that's what, a 10% plus move. So nearly 15% of outperformance by equities against commodities, against DBC. But the situation has to calm down. Will the situation calm down? Yes, one day it will. Will it take a week? Will it take a month? Who knows? But that is something that I'm watching, and I will be watching every day, because if that changes, you're going to have a move right back to this moving average without a doubt, and basically, sort of the middle of this channel. That is the kind of thing that I would expect to happen, a 10-15% move, and it'll happen for both reasons, because A, equities rally, and B, commodity prices come off as a result of some settlement. So this is the moment that you have, this isn't the moment, this is the moment where you have to look at this and then know that if a settlement is reached, you are looking for 22. You're looking for a big move. So if now we're at 819, call it, you're looking for a 15% move to get to 22. So you get more or less the idea how much commodities against equities are going to come in. In these times of uncertainty, you're much safer playing spreads than you are outrights. Now this is SPY over EWG, so states over basically the DAX in constant money, i.e. in dollars. And last week we were here and I told you the only safe play is to be long of it. And here we are making new highs, or closing very close to new highs. To me, there is very little reason, apart from a settlement, and there's absolutely no way that we can know when that will happen, is to stay long this spread. It could go another 10% easily, simply because of events. So I really would recommend that you don't have outright plays, but any kind of short you want to put on, you put it on in Germany or in stocks, and any kind of long that you want to have, you wait for a dip in the US and buy it. This is SPY over FEZ, and basically the same thing, but it's SPY over Europe as a whole. Excuse me. You can see, and it's a daily chart as opposed to a weekly one, you can see that we are right up against all-time highs. And next week we could easily get this kind of move on top of what's happened. So from 978 to 1022. So what's that? 3%. 3% on top of that move. I will tweet when we start breaking this level. This is a very, very important level. I have that enabled. If we start breaking that, that should be a signal that everything that I've been saying so far, i.e. that the differential between bonds and 10-year notes is increasing, that the dollar is falling. Sorry, the dollar is going up against the euro is falling. And that we get a move through here, which could be, at least another 3%. So you're looking for European equities to feel a lot weaker than American equities. One thing that you have to be aware of is that ITOT over government is going basically nowhere. We were here at the in December, and we are still here in at the end of February. We really haven't done anything in the spread between government bonds and the totality of the stock market. Can that change? Yes, but I think that this ratio will remain pretty constant, and that is what tells me that the basically that equities will do what bonds do. There will be days of deviations, of course, but basically the fate of government bonds and the fate of the stock market are more or less continue to be tied together. So really, it's only much higher yields which are really going to hurt the US stock market. As I said, you look at the European stock market, you don't really look at the US stock market. You look at the differential between the US stock market and the European stock market, but in outright trades, you just look at the European stock market, and you can see how well it trades from level to level. This 39.86 level is so important, and basically on Friday we got to it, and that's it. What is going to happen on Monday? I would have thought on Monday the first reaction is to take it down towards 38.44 and see what happens there, i.e. back towards the lows where we were on Friday. The bank sector should really get slammed, is my guess, and that would lead it down. In the DAX, you're looking for a move back down towards this 14,072, and you're looking for much less of a move in the US. This, unfortunately, is a very difficult chart to understand because of the time differences, and these spikes just never happened. But I decided to show it to you in any case because I think it's very telling if you look at it in real time. It's the differential between the VIX H22 and the stocks H22. Really, I've never seen it really trade below minus 130, 135. These spikes are only here because of the time difference when the V-Stocks is settles, as it were, and this is just not following the differential correctly, and I just don't know how to make it do that. I've tried in every which way. I've even asked the help desk, but nobody can seem to help me. So what is going on here is that if this starts trading through minus 130, it's likely to go to minus 200, minus 250. Why do I think that is important to show you? Because it should be reflected, and it should even lead movements in the DAX relative to the US. So if on Monday we see it trading at minus 150, minus 170, that should mean that the relative fall in DAX relative to the US should start getting more and more pronounced. DAX and naturally stocks. And that is something that you need to watch out for on Monday. These spikes never happened, I keep on saying. So I've never seen it trade through 130. So if it starts trading minus 200, you are looking for basically this whole years worth of or months worth of trading to be negated, and for us to start going down to minus 200, minus 250, which would mean much greater volatility in Europe relative to the US, and that has the same implications that I've been trying to explain to you for the differential between bonds and therefore the value of the currency, and also the spread that I've been showing to you between the stocks and the DAX and the S&P. This is the chart of EEM, and look where it stopped, 45.04 dead, and huge rally at the end of the week. To me, this level is going to be so important, and I don't think we smash it for at least a couple of weeks, if ever. So you keep on buying it at 45.04 for the bounces. Should EEM be affected that much by what is going on? Yes, it's going to be relatively weak, but I think that we have given up so much in terms of we're nearly at the 50% retracement of the whole move from the lows. As you can see, that comes in just below, that probably this market is getting quite cheap. And really, EEM, I think, is going to be a relatively good investment at 45.04. I also wanted to show you a chart of the Nikkei, because it closed just inside the 26,940 level on Friday. And just to have certain things in mind, here we have at 24,947, we have the 0.382 retracement from the whole move from the lows, from the COVID lows. And here at 24,200, we have the amazingly important support, which coincides basically with a 200 period weekly moving average. Down here is going to be humongous support. Keep, nothing to do at the moment, but keep it in the back of your mind. These levels around 24,200 to 24,900 are going to be wonderful buying opportunities. Well, the US. I think the US is going to move the least. And what happened last week, basically we took out the stops. And I was looking to buy a little bit lower down, but sold a bunch of puts. So I didn't get hurt. Did I make that much money? No. But on the other hand, it's better than getting buried. I think the US is going to do relatively little. I think this 42.50 area between 42.88 and 42.47 is going to get retested and bought. And really, I still expect that sometime in mid-March we're going to be, higher than we are at the moment. And that is where we await the Fed. I showed you that chart whereby bonds and equities are very much tied together, and the ratio between them is going nowhere. And that is why I think that you're not going to get, because what is going to happen to bonds? Yes, they're going to get bid up, not as much as European bonds, and that actually is going to support equities, is going to support equity valuations. So I really don't see that much movement here in SPY. I see much more movement in European bonds. So basically play that volatility, look at that volatility spread, and when it starts breaking out, then you know that it's time to buy the US and sell Europe, and play the relative game as opposed to the absolute game. NDX had a wonderful bounce from the 13,130 level. If the bonds next week gain some ground, as I've been saying, this is the natural market that's going to bounce most, and probably all the way to 15,000 or 15,120. Not straight away, but that is the one that's actually going to take the strain, and that would make a lot of sense to me. So really do not be short of NDX. That one makes no sense to be short of at the moment. That's the one that makes most sense to be long of at the moment. And if we have a look at what the spreads are saying, Let's see what the VTEX spreads are saying. This is the one that could be most interesting, which is XLF against XLK. I think the X. I think XLF could have a very bad time, and we could go all the way down to 2208. You want to favor XLK over XLF over the course of the next few weeks until the situation. And we are, this channel has been going on, this downward sloping channel has been going on for a long, long time. And, we fell out of it because of COVID and came back into it. But it just doesn't deny the fact that it's a very, very long-term downward sloping channel, i.e. XLF is losing to XLK steadily over time. And we are very, very close to the top of the channel in any case, so really it should be not a surprise to see even a 10% move, relative move of XLK over XLF. And that really is where I'm coming from. To me, NASDAQ next month is not the market to concentrate on. It's probably a market to accumulate. Volatility. I said don't be short of it. There is absolutely no point in being short of it because events are going to overtake you. We actually closed down on the week in volatility. If I enlarge this weekly part, we've had 2 red months and we've never closed above 30.11, which on the week I consider very important. If we have a look and enlarge a daily chart, we can see that we have actually a big unfilled gap all the way up to 37 in the in VIX, and we're coming down, and I think we will be trading between 30 and 22, 23 for the immediate future. But I'm sure that this gap up to 37 at some stage gets closed. So what I'm saying is that you really don't want to be short of volatility again until we close this gap. To me, that makes no sense. This gap will be closed, whether it gets closed in a week or 2 or 3. This level here will trade again. So basically you are patient and you buy dips in this region around 22 for moves again. This chart would suggest that surprises are nowhere near over. The market might hold in for 1, 2, 3 weeks, but at some stage surprises are not going to be over. So to me, in recap, you look at Europe, you look at volatilities, you look at the differential between volatilities, and that is when we decide which side is going to be the weaker for the next few days. The most important thing about the change in the table is the DBC 2439 has been achieved. Until and unless that is exceeded on a weekly close basis, I just can't be bullish of commodities anymore, simply because I have taken my profit. I am in cash for that portion of my of my portfolio, and I will no longer be looking at it. The dollar should now start trading 98.54, and I think that the differential between the bonds and the 10-year note should start going out because of the European situation with their banks. Having said that, these are the levels that you could trade on, we could trade, and therefore the differential goes out to 196 between 10s and Germany, and when that happens we should achieve 98.54 in DXY. We will follow this minute by minute, and I will tweet to you whenever I see these levels touched or exceeded, so that we know what the next leg of this drama could easily bring to us. Gold, I would leave alone because it's just too, it almost impossible to know what is going to happen with the Russian situation. I am sure that they're talking to the Chinese, if they haven't already done it, and arranged some swap line at some value. But we will see. That's what I would have done. But in any case, this one is going to be very difficult to predict. And all we can do is play options at levels. Thank you very much indeed, and tweet you on Monday.